All right, let's talk about Willis Lease Finance Corp., ticker WLFC. They dropped their third quarter earnings on November 4th. And what happened next? Well, it's a classic Wall Street puzzle that we're going to unpack right now.
So here's the big mystery. On paper, the company had a fantastic quarter. They posted a huge beat on both revenue and earnings, and they even signaled a ton of confidence with a massive dividend hike. But what did the market do? It punished the stock, sending it down almost 6%. So what on earth did the market see that the headlines completely missed?
Okay, let's dive into this. First, we really need to understand just how strong these headline numbers actually were, because on the surface, this looked like an absolute blowout quarter. Let's start with the bottom line. Diluted earnings per share, or EPS, came in at a whopping $3.25. I mean, that is a very solid number, and as you're about to see, it was way ahead of what anyone was looking for. And the top line? Just as impressive. Total revenue hit a record $183.4 million. That's a jump of over 25% from the same quarter last year. You know, this kind of growth just shows you the powerful demand they're seeing across the board.
And this table really puts it all into perspective. Look, WLFC didn't just beat expectations, they blew right past them. EPS was 39 cents ahead of what Wall Street was expecting, and revenue beat by more than $27 million. By any measure, that is a significant outperformance.
And then, to top it all off, management announced a major dividend increase. They raised the quarterly payout from 25 cents all the way to 40 cents a share. That is a 60% hike. You just don't make a move like that unless you are incredibly confident about the future cash flows of your business.
So with numbers like that, it's really no surprise that on the earnings call, management was painting a very, very rosy picture. They were focused on these powerful tailwinds that are just pushing their business forward.
And I think this quote from the CEO, Austin Willis, is really telling. He's basically arguing that, hey, after a couple of weird quarters with some one-off events, Q3, this is the real us. This is the pure underlying strength of our core business with no distractions. And they absolutely had the data to back it up. Record lease revenue, record maintenance revenue, portfolio utilization hitting a really strong 86%, and they got a new $750 million credit facility to fund more growth. And this is all happening while engine shortages and maintenance backlogs are forcing airlines to lease more engines for longer. It's really the perfect storm for WLFC. But despite this super compelling bull case, the market clearly wasn't buying it. So traders and their algorithms, they looked right past those headline beats, and they dug into the details. And, well, they found a few things they really didn't like. And this chart illustrates the market's anxiety perfectly. Yeah, revenue growth was strong, but look at the expenses. They were growing even faster. Both G&A costs, that's stuff like salaries and consultant fees, and their net finance costs jumped by over $9 million each. That puts serious pressure on your profit margins. So here's the deal. The market saw this trio of concerns. Number one, costs are rising fast. Number two, they had a pretty significant $10 million write-down on equipment. And number three, and this might be the biggest one, the quality of the earnings was a little questionable. A massive portion of that revenue beat came from a source that is far less predictable and, well, lumpy, as they say. The market hates lumpy. It weighed those risks a lot more heavily than the headline beat.
So we've seen the bull case from management, and we've seen the bear case that was driving the market's reaction. What does this all mean for the stock going forward? Well, let's synthesize all of this into our official take on WLFC.
So, we're initiating our coverage with a market perform rating. Why? Well, those industry tailwinds are just undeniable. They provide a really strong floor for the business. However, the risks around cost control and the questions about the quality and predictability of their earnings, those are significant enough to offset that optimism. It just justifies a neutral stance for now.
And just to be super clear, market perform doesn't mean we're bearish. It's not a sell rating. It simply means we think the stock will probably perform right in line with its peers or the broader market. The powerful catalysts for it to do better are matched by very real, tangible risks. The risk-reward here feels pretty balanced.
But hey, what if you wanted to make a more aggressive bet? Here's a potential hedge fund pitch for you. The thesis is a classic value play. The market is punishing WLFC for short-term noise while completely ignoring the huge gap between its market value, around $850 million, and the underlying value of its assets, which could be well over $1.2 billion. The catalyst to close that gap? Management could get more aggressive with buying back its own stock. So the trade would be to go long WLFC and maybe short an airline ETF like Jets to hedge out any sector-wide risks. It isolates the bet.
And of course, as always, please remember, this is not financial advice.